Welcome back to Full Count Podcast. And oh boy, do we have a problem here in the U.S. economy. It is very unfortunate what's going on for a lot of young first-time home buyers that are just completely priced out all over the country. And I think a lot of this has to do with everything compounding. All these bad decisions or all these government programs, unfortunately, maybe they mean well. And some people would say, actually, they never meant well. It was there to enrich certain people. But President Bush did what's called the American Dream Down Payment Act and the blueprint for the American Dream. Those were good intentional things to make housing more affordable. However, the problem was it loosened a lot of guidelines for loans. So things like no income, no asset, NINA, or subprime mortgages. And not only that, housing was already built. All these homes were being built throughout the United States because there was a lot of incentives. So there was an oversupply in many ways as well. And all this led to the great financial crisis that we all know about during President Bush's term and under Obama's term. Now, not only did that be, an overall problem for the American people, but the debt that kept piling on because of the wars. I mean, President Bush had 2 wars going on, and Obama was just a continuation of that because we went from 2 to 7 wars. And essentially, I think it was about 2 million people filed foreclosure during President Bush, and under Obama it was about 6 million or 5 to 6 million people. And who got bailed out? Was it the homeowners? Not really, no. It was all the banks, the bailouts for the big banks, the auto industry, and AIG. Now, there's a lot of good reason to think it was probably necessary, and I think it kind of was, unfortunately, to some degree, before there being a calamity of some sort with the economy worldwide. That would have been worse. But Obama and Bush should have bailed out more homeowners. I mean, at the end of the day, the average American gets screwed, and it's just a reality. And I think that's why we're getting to the point of the 50-year mortgage. What we have seen with President Trump is home prices did go up. But then it wasn't until 2020 that the interest rates fell artificially low. Prices went up even majorly more, right? That's what's been a big issue. And not only that, we also had seen 2023 to 2025, we've seen home prices soften, but they're still going back up. So the incentive to get the demand up is probably there for a reason. However, I think it always is supply side economics, but I won't get into all that information because that's just too much to think about. I think at the end of the day, what's also a major problem is wages are not keeping up with inflation. And a lot of this goes back to the 60s where, the industrial or manufacturing was offshored. That was a big problem. Then with the tech boom, we also saw that happening as well. So it was all about globalization. So a lot of people were, Americans are upset because a lot of their jobs were lost, unfortunately. And that's just the reality of things. So there's a lot of these other companies or these companies of America utilizing labor in different parts of the world. And they're either eliminating jobs here or they're suppressing the wages. And that's just a huge problem that I'm really against in so many ways. NAFTA was also not very helpful in the 1990s. Canada and Mexico benefited more so than America. I mean, the American corporations did, but the people did not. So that's kind of why we're in this predicament. And I just don't really see the government bailing out people. I think that's why we're going to be seeing more rich people and more poor people, and the middle class is just getting suppressed and suppressed. So when the government comes out and says, hey, we're going to do this for you, I think at the end of the day, it suppresses the middle class, and that's the big problem. So in a way, I see the 50-year mortgage as beneficial, but at the same time, it's going to make these people more in debt. But we'll get into that in just a moment because there's also some beneficial factors to it. So a lot of things come down to the demographics of people, what people are doing with their daily life and how that's affecting the economy. Of course, a lot of young people are saddled with student loan debt, auto loan debt, childcare debt, and many to go on and on and on, which I won't get into. But a lot of people are pushing off marriage for a reason. Either it's too hard in the dating world, which I think a lot of it is that case because of social media, and more so because of economics. Things are too expensive and people are finding, unfortunately, they're getting married later. And what does that do to home ownership? It delays home ownership for the first-time home buyer. We saw the newest statistic. The average first-time home buyer is now 40 years old. I think last year was about 38, but now it's 40 years old. So that's obviously going to, make things not very well for the American people that are trying to own homes. But those that have owned homes for many years, they are, of course, benefiting. And that's why the whole connotation of the boomer is kind of negative, because a lot of these young millennial Generation Z have been really, or the Zoomers have been really upset about what has been happening with the boomer, generation, what they've been doing to the country. But there's always someone to blame, I think a lot of people want to blame someone, and in many cases they might be correct. But at the end of the day, you have to make your own decision, and you have to plan strategically ahead of time to get where you want to be, because I don't think the government will ever be there to help you. At the end of the day, it's going to be more so detrimental, I think, than anything, for the most part anyways. I'm not going to say always, but for the most part. So I want to get into the data that's going to be helpful for us to kind of wrap our heads around what's going on. And then I'll talk about the 50-year mortgage in a little bit more in detail, why I'm against it to some degree, but also for it. So the average age of a first-time home buyer is now 40. For obvious reasons with demographics, but before we go even further into that, I do want to mention, as a seasoned real estate agent and what you read in articles, the reality is true. There's what's called Nepo Homebuyers. Now, it's given the data that about 39% of all homeowners receive down payment help from parents or some source of support. That's quite a lot of bit of people. Now, when it comes to the younger generations like Gen Z, our millennials are getting 54% of those home buyers are getting help from parents or some type of support for the down payment money. And then 78% of them are getting it as well in the Gen Z bracket. So, of course, it makes sense, because saving for a down payment where wages are down, you're going to need some help. And if you have a family member that has that money to gift you the money, it only makes sense why you're doing that. So I don't blame them. What I feel bad for is people that don't have that money from their parents or a family member that can gift them that money. But I think that's why it's so important. I feel like a lot of parents or older people that have a home have more of an ability to do things, because they have that equity to work with. They've been able to, keep their housing situation payment lower than if you're always renting and, moving around. So that's why it's helpful to, own property and have your family members own property, so everyone can be on that equal playing field per se. But if you don't, then you're kind of in a bad luck situation where you can't even get gift money. So that's kind of where that's at. And another statistic that came out from Northwestern Mutual, which was really sad to see because of the reality of what people are going through. The people that don't get gift money, I feel like, fall into this bracket, which is more than 50% of Gen Zers and nearly 60% of millennials reported that they're depending on their inheritance to achieve financial security and retire in comfort, meaning they need to wait for their parents to pass away or their grandparents or someone so that they can live their life and own something. And that's really depressing to hear that. But that's just, I guess, the reality of where we're at nowadays. But I don't know. It's really sad, but it's definitely not strategic. You need to plan, whether you're in that position or not, waiting for a family member to pass away and get that inherited. Whether that's the case, you need to plan so you can get it on your own, at least try to. And I think one of the best ways of doing that is to probably get married, because now you have dual incomes. You're able to feel a little bit better and have breathing room. I know society steers people away, or has. I think it's kind of coming back now to be single and go date and do all this crap. And it's obviously not helping people. It's probably best to find your partner and go forward and financially find independence. So let's get into demographics of first-time home buyers, because I did say it's about age 40 based on the statistics. But if we look at this graph from National Association of Realtors, it kind of narrows things down even further. Now, let's take a look at this graph. So the first-time home buyer is now 40 years old, but the repeat buyers is 62 years old or 60 years old, one of the two. That is horrible, guys. That means older people are the only ones that have the ability to continuously buy. After their first home, sometime later on in their life, they're buying another home. And that's what we're seeing, is older people buying homes. Again, because they went in when home prices were a lot lower back in the day. And also the wages were probably much better than they are now. So that's something to take into account. And here it breaks it down even further. Approximately when it comes to the first time home buyer, 50% of them are married couples. And then the remaining first time home buyers, 25% are single women. Totally agree. I've seen it with my own clients. A lot of single women doing their thing. So congrats to them. That's amazing. Only 10% are single men. So they're really falling behind. And then the other 15% are unmarried couples or household compositions of all sorts. So that's where it comes down to 50% are married couples. So that's why I'm saying, like, finding a partner and forming your own foundation of finance independence, I think that's the way to go. And a lot of the women are doing good too on their own. I mean, 25%, that's a lot. And the men are the ones that are really suffering. And I think a lot of that is just the mindset, unfortunately. A lot of what they've been taught, it's just not good. Video games, focusing on stuff like that, and not really getting their act together and being ambitious is hurting them a lot. So here's a graph that has been recirculating since the 50-year mortgage has come up. And Marjorie Taylor Greene was the first one, I believe, one of the first ones to share this that went wildly out there. But that is the percentage of 30-year-olds who are both married and homeowners is only 12%, when back in the 1950s was about 50% of the population. Now, I looked online to see how accurate that is, and it basically told me it's very accurate, but there's no specific statistic tailored to 30-year-olds only, just 30-year-olds, not early 30s, not people in their 30s, but 30 years old. So I got additional data to share with you. So the number of homeowners in their early 30s that own a home is 50%. Not bad. The number of Americans in their 30s that are married is 57%. So it's a lot higher than I expected, although I do see that statistic to tread downward as time goes on, because of course, people are getting married later, having babies later, getting a house way later because of everything we've already discussed. The public data from sources like iProperty Management show that as of late 2025 data, only about 49.2% of people aged 30 to 34 own a home, regardless of marital status. And I think, again, without marriage and kids, home ownership feels more pointless and is more out of reach financially. So that's kind of the problem here. But somehow they got the data that it comes down to 12%. So I guess 50% times 57%, you get a lower percentage, of course. And somehow they were able to factor in 30-year-olds particularly, and they got 12%. Obviously, that's horrible if that's the case. You go from 50% in 1950. You would think with time in a country, things would get better. Not that, before that time when we first became a country, it obviously had improved. But I feel like the 1950s and 60s is when things after that went downward. And maybe it's all the wars. I don't know. I mean, we could get into that some other time, but something's wrong. Something's not good right now. And it's really unfortunate to see. But FDR, I believe in the 1940s, what he did was he started the whole 30-year mortgage because he wanted to encourage people to own. I think at the time, there was only 15-year mortgages, maybe. I might be wrong. But he added the 30-year mortgage, and that increased home ownership percentage of Americans to own a home. President Trump is trying to do the same exact thing. Of course, we've all seen by now the 50-year mortgage has been touted by President Trump. And FDR, what he did at his term back in the day in the 1940s, I believe, he included what's called the 30-year mortgage. And that encouraged a lot of Americans to own a home. And it worked for affordability purposes. But when you tie in adding a 50-year mortgage now under President Trump that might happen, that I believe is actually going to encourage more homeowners because the wave of demand is going to increase, of course, because now people can afford more home than if they would have done a 30-year mortgage. And in many ways, that's very beneficial and good. I feel that people back during Roosevelt's time might have been, feeling the same way in a negative fashion as they are with President Trump, but it ended up helping out. However, when you look at the math and do 50-year mortgage, it may not really make sense, because if your first-time home buyer on average is 40 years old and you get a 50-year mortgage, then you're going to be 90. So you're basically renting forever. But the thing that a lot of people don't mention as well, and I feel like it needs to be included out there, is the fact that the average homeowner only lives in their home. When they buy a home, they end up selling it after 11 or 12 years. So it's not like all these people are going to be stuck in these 50-year mortgages paying crazy interest. They're going to end up leaving that loan or refinancing. So that's where people need to take a deep breath. It's not like people that buy with the 50-year or 30-year are locked in forever. They're not. They usually end up leaving. So if this can actually help bring a new form of wave of demand, that's going to be obviously beneficial, everybody. Like, let's think about it for a minute. It's going to help a lot of young people own a home. And if they're smart, which I hope they are, and they have the right mentorship, they're going to sell or refinance that loan out of the 50-year mortgage. And they're going to be fine. They at least got their foot in the door. But at the same time, it's not good, because what's this going to do? Home prices are going to increase because a new wave of demand is going to come into play. And who's that benefiting? People that have owned homes. That's where people call it the boomer situation. That's why people get upset. Young people get upset. So I don't know the answer, but I want to go ahead and mention some statistics from these well-known housing analysts that I want to read off of. So let's get into that. And Resi Club is a good housing analyst that is just good to look at the data. And it basically, I wanted to talk to you about how the 30-year mortgage is going to be a lower interest rate than a 50-year, of course, because now the investors have to lock in a price or an interest rate for a longer term. So, of course, they're going to charge a higher interest rate. But looking at the data from a 15-year to a 30-year, you normally see the average higher interest rates about 57 basis points, so a little over 0.5%. From when you get a 15-year mortgage, it's cheaper. And when you go to the 30-year, you're paying about 0.5% or a little bit more to have that 30-year, because you're locking in that fixed rate for a longer period of time. And investors need a way to find some risk management. So that's why they charge you a little bit more. So here's a graph that basically just shows that and gives you that spread to see that's consistently about 57 basis points. And the reason why I share that is because Logan Motashami, who was part of Housing Wire, sorry if I mispronounce your last name, but he tells Resi Club that he estimates a 50-year mortgage would carry an interest rate roughly 42 to 57 basis points higher than the standard 30-year mortgage. So yes, your 50-year mortgage will be less expensive per month, and you'll be able to qualify for the home rather than if you went with the 30-year. And again, your payment's going to be lower because the 50 years spread out so much longer. However, you are going to have a higher interest rate by 42 to 57 basis points. So basically 0.5% higher. So if you go with the 30-year, you're going to get a 6%, right? With all things speaking, very simple, but not everything's simple. But in any case, 6%. You go with the 7-year, it's going to be 6.5%. The problem, though, is that long term, you're paying interest on most of that time frame only. You're not paying down the principal. So you're going to be paying so much more than if you went with the 30-year. And that's the problem if you stick around to pay off the home for 50 years. So here's the data I want to share with you. Lance Lambert with Resi Club, he says that on the same 400,000 loan example, right? And I don't think he gives an example of the interest rate, but let's say all things being relatively the same, but 0.5% higher with the 50-year, a 30-year borrower would pay roughly $483,000 in interest in the time it's paid off. So you get a $400,000 loan. Yes, you pay off the $400,000 principal loan, but you end up paying a $483,000 of interest. So you're paying really $883,000 for the home. Everybody kind of knows that when you've already bought a home with a 30-year fix or you're getting pre-qualified. You get the gist and you understand that that's the case. You end up paying double than what you paid for the home. But when you look at a 50-year, it's closer, according to Lance, to $980,000 now that you're paying in interest versus $483,000. So roughly $500,000 more in financing costs when you go from a 30 to a 50 year. Now, I do understand, again, the affordability is a thing, but you are going to be paying a hell of a lot of interest. So is it really beneficial? It's hard to give that answer, because in a way it is, in a way it isn't. And I think it's going to be a niche product, this 50-year mortgage. I don't think everyone's going to get a 50-year, but I do think there's going to be a niche of people that will take it. So let's go with Stephen Graham. He's also a great housing analyst. And he says jumping from a 15-year mortgage to a 30-year mortgage lowers your payments by 34%. Because again, a 15-year mortgage, you end up getting a lower interest rate than you do with a 30-year because it's spread out longer, right? So they're going to charge you higher interest, but you still get a break on the payment. And that break from a 15 to 30 years, 34%. Now, the difference between a 50-year mortgage from a 30-year, you're only saving 8% per month. I mean, that's not drastic like it was from 15 to 30. And say you take a $500,000 loan, a 30-year mortgage at 6% costs roughly $3,000 per month. Again, this is per gram. But a 50-year term leads to a higher rate, say 7%. So he's actually jumping it from what I was saying earlier from Logan at 57 basis points. He's rounding it to a whole percentage higher on the interest rate. And that works out to $3,008 per month. Almost no difference. Even if the rates were equal, you get a discount of just $368 per month. So there he's just saying that you get a $368 per month less in mortgage payments with the 50-year. And a 10% discount for another 20 years of debt. So I don't know. It's hard to say. I think everybody has their own unique idea of what's a good deal and what's not a good deal. If you have to use a 50-year mortgage in order to get your foot in the door and own a home, maybe it's necessary, but make sure you sell, I don't know, 5 years, 7 years down the line, or refinance, and don't have that 50-year mortgage to shackle you down financially. You want to get out of that eventually. So if it takes that, then do it. I mean, I have clients that have used their retirement money and then they pay themselves back and they use that down payment money to get into the home, and it ends up working out great. I know some financial advisors aren't for that, but at the end of the day, if it gets you through the door, it's probably worth it. And again, the government has programs. A lot of times it's more of a moral hazard situation. It's best off that you just not think about them, that they're going to help and save you, because they're probably not. And I don't want to get into it, but they're probably not. So just strategically plan and find ways to get yourself into home ownership. Or if you're already a homeowner, find ways to save money, invest in certain assets that appreciate. If you need to sell your home, do it and get into a better home or a better area, location. So just plan, everyone, and everything will be okay.